Everyone, market person or not, has noticed gold rising. This didn't happen randomly or overnight. And scarcity matter, yes, but inflation, geopolitics, and economic stress also matter. Today, we will focus only on inflation and ask a clean question. Is gold unique? Or are there other assets that behave like this? And how should we actually look at inflation? Do they tell us the timing of when to sell, when to buy, and what they really show us? And what can we understand? To understand this better, I looked at monthly data. I took inflation, Nifty 50, oil and gas index, and Brent crude, and calculated monthly returns for all of them. Along with that, I also marked the inflation trend, whether inflation was going up or coming down, just to see the bigger picture. Now, if you look at this table on the left side, it tells us something very important. You can see how each asset performs month by month and whether they are actually moving together or not. And just by looking at this, one thing's become clear. The movement is not linear because sometimes inflation is up, assets are down. Sometimes inflation is down, assets are up. So inflation here is not clearly behaving like a perfect lagging indicator or a coincidence indicator. What this really tells us is simple. Inflation is not the only factor driving assets return. After looking at the monthly data, the next obvious step was to check correlation. Correlation basically tell us whether two things move together or not. Nothing more than that. So I checked the correlation between inflation and different assets, and the result was not strong. In some cases, it was slightly positive, in some cases, negative. But overall, there was no clear or stable relationship. Now, this is where people often misunderstood inflation. They expect inflation to behave like a clean signal, but correlation only captures average movement, not context, not regimes, not expectations. So, a weak correlation doesn't mean inflation is irrelevant. It simply means that inflation doesn't act alone. And as we said earlier, that inflation is not the only factor. Now it is showing even when we isolate inflation, the relationship is weak, and that's the evidence. Now there is one more table here, the performance summary table. This table looks at something slightly different. It shows the average returns when inflation was going up and when inflation was coming down. And at first glance, this table actually looks interesting. For example, Brent shows positive average return during inflation up periods and negative returns when inflation is down. So if we look only at this table, it can feel like there is a good relationship. But this is where we need to be careful because when we look at the correlation table, we see that this relationship is not very consistent across times, and which tell us Something important. Inflation may influence returns in certain phases, but it does not drive them alone or continuously. That's why these two tables should be seen together, not separately. A performance summary gives us context, but it is not enough to make a stand-alone portfolio decision. We can't say this asset doesn't hedge inflation, so we don't invest in it at all. Real portfolios don't work on one variable, they work on multiple forces acting together. This is where graphs really help because they organize the mess. Till now, we are looking at tables, averages, correlations, and everything felt a little scattered. Here, I have plotted two things together. One line shows asset returns, and other shows the inflation regime, where 0 means inflation is coming down and 1 means inflation is moving up. And honestly, once you see this visually, things feel like more intuitive. You can start noticing where certain moves cluster, where relationships appear stronger, and where they are break clearly break. This doesn't mean inflation suddenly becomes a perfect indicator. No, but it does support what we said earlier, that we shouldn't look at any single measure in isolation. Tables give us structure, correlation gives us discipline, and graphs give us context. Together, they help us think better, not predict perfectly. And somehow it is true and helpful. So, if I had to wrap this up simply, gold rising over the last few years is not because of one single reason. Scarcity matters, inflation matters, geopolitics and economic conditions matter. But what the analysis show is not that inflation is useless and not that gold perfectly hedges inflation, but it shows something more practical. And it is inflation works more like a background condition than a buy-sell signal. Sometimes assets respond to it clearly, sometimes they don't, and that depends on many other forces acting together. That's why look at one table, one correlation, or one chart in isolation can be misleading. When we look at performance summaries, correlations, and visual together, we get context, not certainty. And in real market, better context is often more valuable than perfect predictions.